Don't forget where gold comes from. It comes from the last 3 years has been skyrocketing. Okay, it's what we call it was a crowded trade. The US dollar is 57% of foreign reserves. First of all, 20% the euro, and the rest being the other currencies: the yen, the renminbi, the British pound, Swiss franc. I don't believe in the ceasefire because the points that the Americans are requiring from the Iranians and the points that the Iranians are requiring from the Americans don't match at all. So we'll see what happens in Islamabad Friday. The Swiss franc has the advantage of having a strong financial system, okay, political stability, very, very stable, always neutral, and that's helping the Swiss francs. With sanctions, you never know with this Trump administration how he's going to react. So a lot of countries have moved into, central banks have moved into gold, and that's a de-dollarization effect. Once again, if I knew Shahar, I wouldn't be sitting here. If I knew where oil was going, I mean, it's like oil has to be seen in a different way. Yes, because the bonds this time acted as an inflationary fear. Here it's an oil shock, which means higher inflation. I mean, the gas at the pump in the US went from $3 to $4. It went up 30% within a month.
Hi everyone, welcome to the podcast. In this podcast, we're going to be diving into the world of asset classes, and today I'm joined by a professor of mine at SKEMA Business School, Mr. Tarek Amyuni. Before we kickstart this podcast, I would like to give an introduction of Professor Tarek. Before stepping into academia, Professor Tarek was actually a professional forex trader at Merrill Lynch for about a decade. And after that, he has now spent over 25 years teaching students at SKEMA Business School. Professor Tarek Amyuni is the senior lecturer and an associate professor at the campus. He is also the founder of the MSc Financial Markets and Investments course at SKEMA, which is also the course ranked second worldwide in terms of rankings by Financial Times. Professor Tarek was also heading the MSc Financial Markets and Investments course until last year, so he had a 25-year great run. He teaches fixed income, he teaches financial derivatives, international financial economics, and technical analysis at the campus. So, Professor Tarek, thank you very much for being here, and tell us how you feel today.
Thank you for having me, and very honored to be on your podcast and to have you as a student, a brilliant student. So it's always a pleasure to participate in your podcast. And I think
Thank you very much.
We're doing this on a historic day, I guess.
Yeah, I mean, a lot happened overnight in the world and also in my personal portfolio, which when I slept was -6%, and I woke up and it's just like roughly +1%. So so a lot happened. Okay, great. So the idea of this podcast is, of course, as I told you, to discuss different asset classes, yeah? And since you come from a forex background, and I know that you are also interested a lot in commodities and so many different asset classes, and you teach fixed income to us at campus, so maybe let's start from FX, yeah? My first question is going to be about the US dollar, which is the talk of the town. Everyone talks about it. Everyone has different opinions about the US dollar. So first question is, why was the US dollar appreciating when US was actively waging war against Iran? Why did it still have a safe haven status? And what happens now when, as we know, there is a 2-week ceasefire announced and we see USD against currencies is going back down? So can you explain?
I can try. There's no right science in FX or in financial markets. Let's start from the beginning. The US dollar is 57% of foreign reserves. Okay, first of all, 20% the euro, and the rest being the other currencies: the yen, the renminbi, the British pound, Swiss franc, etc. There are two major points that defends the dollar. It's the resiliency of its economy, first of all, which always supports the currency. Don't forget, it's the currency that is used to trade commodities worldwide. Okay, so the strength of the dollar remains a safe haven. We've seen it during the first clash of the war here. It didn't move much. It did go down to 114.50. I mean, didn't go down that much, but it still remained a safe haven currencies. What might move it away from its safe haven currency might be the state of its trade and budget deficit. Budget deficit being 6% of GDP, which is huge. The protectionist trade policies from the Trump administration, which are not helping, and especially you have new regional trading deals. The Chinese, the Indians, etc., out east. So this will be some factors that can weaken the U.S. economy and make it become less of a safe haven currency. And the other strength of the dollar, it's, as I said, the resiliency of its economy, the AI investments, the need for dollar for AI investments, and the commodity trading in that currency. So we didn't see really a huge safe haven move as we would have had in 1990 during the first Gulf War. So we're seeing sort of deterioration of this safe havenness of the currency in the US dollar.
Okay. So what you're saying is the intensity of US and investors fleeing to the US dollar in times of crisis was not seen as dramatically this time as it would have been in the past. Yeah,
Correct. Correct.
makes sense.
Correct.
Actually, yeah. Also circling back on this point, actually this morning I was reading a great post by a macro analyst that I follow. Because you mentioned the budget deficits of the US. I was reading something similar, but on the debt to GDP ratio of the US, which is over 130% or so. And the stat is quite interesting that the person was saying in the past there have been 52 instances of countries or empires that reached a debt to GDP ratio of 130% plus, and 51 out of 52 have resulted in a debt default. Argentina, Sri Lanka, Greece, all of these other, and the Roman Empire. And the only one exception is US post World War II. So for me as a student, yeah, I see like debt to GDP 100% plus, your debt is bigger than your GDP. How does one really think about debt to GDP? Yes, and what can a country do? You have 130% of debt and your GDP is less than your debt. And how does it all work?
Okay. The debt problem is worldwide. It's not only the US. So you have France, where we are here, has a debt GDP in the 110%. The only countries that have low debt GDP would be the oil producing countries. Saudi Arabia has like a 25%, and still the debt GDP is increasing because of lower oil prices. We'll talk about this later, I guess. But the debt is becoming unsustainable everywhere. And everybody, all the economists and the macro commentators always talk about the unsustainability of debt, and that something has to happen at one point. As long as the debt builds up, as long as the interest on the debt is lower than the interest it generates in return, it's fine. If you borrowed 5% for a project that gives you 10%, nothing wrong with getting in debt, okay? But here, it's not the case. So there will be a point, and Jeffrey Gundlach from Double Line always mentions on his podcast that we'll get to a point where he was suggesting that the US just defaults on its debt, and we'll have 2 generations of big financial problems, but at least the debt will be cleaned up. So there will be a point after which the debt level will have to be tackled. Politically, it's a political issue. And as you know, politicians, all they think about is getting elected by promising things that they cannot sustain to the cost of debt. The debt is going to be a problem at one point. It is a problem already. There will be a tipping point. There will be a big default from one of the major industrialized Western or industrialized countries, and that'll be the beginning of a financial crisis. But I don't think this is yet to happen now.
Makes sense. Okay. Let's also go back to FX again. We discussed the US dollar and their economy. Let's maybe move to European countries. Swiss franc, one of the hot currencies everyone talks about, and during this war it was being talked about. So is it a safe haven, or why was it appreciating, and why has it been? Because last year I think the Swiss franc appreciated 15% against the dollar. So what's driving this appreciation and this status of the CHF?
The Swiss franc, excuse me, has the advantage of having a strong financial system, okay, political stability, very, very stable, always neutral. And that's helping the Swiss francs. They have strong financial institutions, even though Credit Suisse went down, but you have a lot still UBS, you have Julius Baer, you have a lot of private banking. So I think it's neutrality, it's political stability, strong financial system. It's low inflation, okay, low inflation rate in Switzerland always, okay, and a sound fiscal policy as well. So all those factors make the Swiss franc attractive during crisis where people park their money. Okay, Singapore dollar is going to be, I know you're going to ask me about Singapore dollar is a little different. If we want to bounce on this, I can do it right away.
Yeah,
It's
sure,
not
we
really,
should do it.
yeah, it's not really classified as a safe haven currency. Okay, it's like when the interest rates are low, so, the SIBOR, Singapore interbank offering rates at around 3%, so low interest rates. It does show like Switzerland some political stability for sure. Okay, strong fiscal position as well as and robust financial center like in private banking as well. but it's not considered a safe haven currency because its economy is more tied to global trade with its harbors, which is not the case for Switzerland. So whenever trade channels the right way and goes normally, then the Singaporean dollar is fine. But it's not acting as safe. We haven't seen the Singapore dollar appreciate like the Swiss franc has during this latest crisis here in Iran.
Yeah,
So more
that's
tied.
actually
So Swiss franc more tied to its financial sector. They both have political stability, fiscal stability, strong financial institution. But Singapore is more tied to global trade than Switzerland is.
makes sense. That's also quite interesting, yeah, your viewpoint on the Singaporean dollar, because again, going back to this macro analyst that I follow, who was talking about the US debt to GDP, he was also talking about CHF and SGD. And what he says is, of course, the factors you mentioned, political stability, other things. He also adds another element to it, and that is political neutrality. And that is quite interesting. What he mentioned that during the war against Russian invasion of Ukraine, I think Switzerland also participated in sanctions against the Russian Empire. Yeah, and that was one of those let's say points for investors that okay, so we are putting money in CHF, but then CHF is not really politically neutral because they are also taking part in sanctions, and that's when a lot of money started moving into the Singaporean dollar. Do you have any thoughts there?
Yeah, because Switzerland is not part of the European monetary system, sort of, and not dictated by the ECB. They have their own central bank. And by the way, a lot of students don't know, but the central bank of Switzerland actually trades on the Swiss exchange, just like a public company. So a lot of people ignore this. Coming back to the Russian assets, the Russian assets were partly frozen in Switzerland, not as fast as they were in the European Union. And then the flow of Russian money went to the Gulf banks, towards Dubai. So Switzerland didn't have to freeze that much assets because they had flown away to the Middle East banks, mainly the Dubai banks.
Okay.
Same with Monaco, which is also a private banking area. A lot of money took off from Monaco to go to the Emirati banks.
Okay. Awesome. Okay. Maybe let's move to another currency now, and that is the Australian dollar. I don't know how popular it is or how much people talk about it, but at least I was reading something and I came across the Australian dollar and I noticed that it has also been strengthening against the US dollar over the last year, and of course after the war broke out, the US Iran, it gave back some gains. What are the reasons why? First of all, is it also one of the safe havens like USD, CHF, SGD, more like CHF, or are there like totally macroeconomic, Australian macroeconomic story playing behind the strength of AUD?
Okay, the Australian dollar and the New Zealand dollars are considered commodity currencies. Okay, commodity currencies. Australia is a commodity currency. They have a lot of copper. They have a lot of raw material and mines, and their interest rates have always been attractive. I mean, it was the carry trade. When we talk about carry trade, it was borrowing Swiss franc, investing Australian dollar. That was the big carry trade of the 90s and even lately. So the Australian dollar benefits from higher interest rate compared to the Japanese yen, the Swiss franc, the dollar. That's always been an attractive currency. They have a reduced cost of trading as well. I mean, they have entered into the flow of FX trading by reducing a lot of the cost of trading. And they benefit from this and from favorable interest rates always. So whenever there's inflation, commodities obviously go up in price. They're exporters of commodities. Okay, so there's an attraction for their currencies because they're an export commodity country. Plus, their interest rate is tied to inflation, which itself is tied to raw material. So when raw material goes up in price, interest rates go up, and there's a flow of money goes towards Australian dollars. So you'll always see the Australian dollars go up whenever you see inflation picking up, but not as a safe haven currencies. Not as a safe haven.
Okay.
No.
That makes sense. And
same,
when you say
same with the New Zealand dollar, which are the bigger export of cotton. Okay, New Zealand's bigger export of cotton. Same thing. Those two currencies, those two countries are very correlated interest rate wise and flow wise, flow of money wise.
But so what does commodity currencies mean?
Commodity currency mean countries that benefit when commodity prices go up. Canada has a commodity currencies, they have oil. Mexico could be considered a commodity currency. Australia is more mining, okay, more mining, more metals. Mexico would be oil. You have countries in the Central African countries that have a lot of manganese, a lot of cobalt, but the currencies are not tradable. But those are kind of commodity currencies. We talked about in class about emerging markets. Okay, those emerging markets, commodity countries benefit much. They benefit a lot when there's a big demand for their commodities, and that's when you want to invest
Okay.
in those emerging countries.
Okay. But then, okay, maybe it might be a very basic or stupid question, but then, okay, I understand what commodity currencies mean, but then don't you, when you need to trade, you still need the US dollar. So the demand, like, how is the commodity currency appreciating in this case?
No, because Australian is considered a trading commodity, so you pay in
Okay.
Australian dollars. You pay them in Australian
All
dollars.
right. Okay. That's interesting.
Same
I
with
did not know that.
the South African rands. Same thing with South African rand. When you buy gold from South Africa or their commodities, you're paying in their local currency. The dollar is used mainly in non-tradable countries that have those commodities. Okay, you talk about Ghana, you talk about Ivory Coast for coffee. All those countries. Then you use the dollar, indeed.
Okay. Okay, that makes sense. That makes so much sense. Okay, now let's move to the Japanese yen, the big dog, because I know that Japanese yen is the. I mean, I think from what I understand about the Japanese yen, so much investments of Japan have been in U.S. Treasuries. A lot of conversation about the carry trade and the exchange rate of USD and JPY is important and tell us and maybe give us, if people don't know anything, yeah, how USDJPY works, why it is important, where it is right now, because I know it's at roughly 158, 160 dollar to the yen right now. And historically, this has been an important level. In 2024, when Japanese yen was at 160, we saw a great unwind and carry trade unwinding happen. So give us an overview.
Okay, Japan is a big importer of energy, of raw material, and so the level of their currency is going to be important for their imports. Okay, if they have a currency that is weak, that's going to be inflationary for them to import. It's going to cost them more to import those goods into the country, and that's going to be inflationary. So a weak currency is always inflationary. Okay, Japan is dependent on a lot of imports of raw material and of energy. You have the MUFG, which is a big Japanese bank, expects the yen to go back to 152 in the first quarter of 2027. Where we stand right now is around 159.60. And we did see, as you said very correctly, indeed a lot of intervention from the BOJ, the Bank of Japan, when that level of 160 is reached, because as the yen weakens, obviously it costs them more to import, so it's inflationary. It's inflationary. And as they import a lot, that creates inflation into the country. And we've seen the yields on the Japanese yen skyrocket in the last year. Okay, we see the short-term rates, the long-term rates are 240%. The US is about 440%. So this carry trade you'll be talking about is not as interesting anymore because the cost of hedging has gone up. But we might not see right away an intervention at 160 by the BOJ for the simple reason is that insurance companies that used to buy treasury bonds from the US are now able to buy JGBs, Japanese government bonds, at 240% instead of 440%, but they don't need to hedge it anymore. By buying the US bond, they had to hedge the currency. Okay, that means they had to hedge against a decrease in the dollar, and that would cost them in yield. So now we might see a move away from US treasuries by the Japanese institution and more into their own, eliminating therefore the foreign exchange risk, which means there might be a pressure on US bonds. Obviously, if there's less buyers of US bonds, the yields might go up, and we'll talk about this a little later, I think. But the key point here is I don't believe there'll be, everybody's waiting for this 160 yen to the dollar intervention. Because of this new interest rate increase in Japan, I think this intervention might not come as early as expected by the market.
Makes sense. All right. And if you were to explain what is the yen carry trade, for me again as a revision, and for people who don't know, what is the yen carry trade?
Okay. The yen carry trade is when you borrow, or yen or Swiss franc, is when you borrow in a low interest rate currency and you invest in a high interest rate currency. So the low interest rate currency, which we call the funding currencies, are going to be today the yen, the Swiss franc, are the major ones with extremely low interest rates. So you borrow in those currency and then you invest in commodity currencies, as we talked earlier, in high interest rate currency. Okay? The risk being a depreciation in the high interest rate currency. Okay, but this is what the carry trade is, and the carry trade today is not as attractive as before because the yen interest rates have gone up. So now it costs you more to borrow in yen, and the interest rate differential between the yen and those commodity currencies has narrowed. So the juice is pretty much gone on those carry trades. So the Swiss franc remains the low interest rate currency. So a lot of the carry trade might move from yen to Swiss franc vis-a-vis the other investment currencies. So funding currencies are the currencies you borrow in, and investment currencies are the currencies you invest in. The commodity currencies, the high interest rate currencies. That's what carry trade is all about.
Got it. I was looking at some stats, and I was looking at who holds the US Treasuries, and a big portion of it is being held by foreign investors, and Japanese investors is one of them. So let's say which the stat or the research that you're talking about, that the Japanese yen might go back to 152. So this is one of those hints of the carry trade unwind, yeah? Because I understand that the Japanese yen would appreciate against the dollar going back to 152. So people would not want to stay in US Treasuries because they can just go back to Japan, yeah?
Exactly. That's exactly it.
Okay.
Exactly right.
Okay, that makes some sense. All right.
Exactly
Got it.
right. Putting pressure
Uh,
on US Treasury yields, which we'll talk about later, I guess.
yeah. So I think FX is quite clear. Maybe I should move to commodities, which is my hobby lately after what has happened with gold and silver has been crazy. Yeah. So in class you often talk about risk on and risk off assets, and as I understand, gold is risk off. Correct me if I'm wrong. Yeah. But what happened with gold during the war? I know that there was a massive rally in gold, central bank buying happened, a lot of things were happening. But after the war broke out, the US Iran in the end of February, gold fell massively, was minus 13%, at one point was minus 20%. Today, after the ceasefire, is going back up again. But isn't this behaving in the opposite way? When there is risk, it needs to go up. And when there is no risk, it needs to go like do whatever. Yeah. But when there was risk, gold was falling. So what's happening here?
Okay, first of all, don't forget where gold comes from. Okay, it comes from the last 3 years. Has been skyrocketing. Okay, it's what we call it was a crowded trade. Everybody was in gold. Okay, when everybody's in an asset, you might start thinking of lining up your position when it's a crowded trade. Okay, and don't forget, gold does not distribute dividends. There's no interest of holding gold. Okay, from holding gold. And why did gold go down when the market goes down? As I told you guys in class, it's when the equity market or other markets go down, people buy on leverage. A lot of people buy on leverage, okay? And then you have what we call margin calls. Once the margin calls hit, you need to come up with fresh money to meet your margin calls. So you need to sell something that's extremely liquid and an asset you've made money in. That could be treasury bonds or gold. Okay, so that's why gold goes down when there's a crisis. Now, at the beginning of a crisis, of a downfall in equities, you'll see gold go up because people are going to gold. And then when the market starts going down too much, accelerates, the downward spiral accelerates, that's when you see the margin calls appear and the sale of those safe assets beginning to happen to meet their margin calls. Okay, and we can see today, for example, as the equity market is skyrocketing this morning, it was up, pre-market was up 5% in Europe, 6% in Tokyo. You see gold going back up. So gold seems to be correlated right now as an asset class to equities. I mean, you see yields go down, equities go up. Okay, so everything's going up. Everything's correlated. I mean, during the financial crisis, everything was correlated on the downside. I mean, we talked about in class the 60-40 models. 60 equities, 40% bonds. Didn't work out because yields went up and the stocks went down. So coming back to gold, gold seems to be correlated to as an asset class to equities, but then it acts as a safe haven until a certain point. until a certain point. When things start to deteriorate too much and too quickly, you'll see bonds and gold being sold to meet the margin calls. So that's mainly what happened on gold.
I would also like to pitch in here. I was watching someone who explained it also very beautifully, who said that gold is something that you buy during uncertainty to sell during uncertainty. Yeah. So you're buying it during uncertainty, and then of course you're buying it because when the real uncertainty happens, you sell gold and then cash out. So that was also a good one-line explainer. You were buying it all the way because you were uncertain in a lot of things, the debasement, US hegemony, and then when the event actually happened, you sell it during uncertainty.
Yeah.
So that was a good explanation. But also, I don't know if you have been tracking the news of central banks and how they have been, transacting with
largest
gold.
buyers of gold in the last 2-3. Yeah, that's a de-dollarization of those central banks. The Chinese central bank, the Russian central bank, who were holding. Well, the Russians don't hold any more U.S. dollar denominated assets, but the Chinese still have a lot of bonds. They were the largest buyer of bonds at one point during the year 2000 when they were booming. They were parking all their extra cash, their foreign reserves in dollars, and they've decreased this dollar holding and moving it into gold. So a lot of those countries that feel they might be sanctioned by the U.S.
Okay.
on their dollar holdings have moved into gold to make sure, and physical gold, because there's a difference between holding physical gold and holding gold mine stocks or gold stocks. It's totally different, okay? The security is through, for example, France just moved about 50 tons of gold from New York vaults to France last week. Okay, they want the physical U.S. sanctions. You never know with this Trump administration how he's going to react. So a lot of countries have moved into, central banks have moved into gold, and that's a de-dollarization effect. Once again, we're talking about the dollar earlier, which is another burden on the dollar as less of a safe haven currency replaced by gold.
Interesting. While we are on the topic of gold, I was reading that the Central Bank of Turkey was selling gold, and I was reading that the reason was to manage inflation and of course other things. So, can you explain this part? Because I was kind of confused. So you have gold holdings, you have been buying gold, but your inflation is running high, so you are selling gold for what exactly? And how can gold and inflation of a country is related?
Okay, for Turkish example, their currency has been devaluing nearly 100% for the last 5 years. So inflation is huge in this country. It's about, it reached like 37% at one point last year. So the reason they sell gold as their foreign reserve is to support their currency. They sell the gold and convert those gold dollars into Turkish lira to support the currency. As they support the currency, they have a higher purchasing power. It costs them less to import, and that reduces inflation. But their situation is such in a bad shape that despite the sales of gold and support, every time they've tried to support their currency, it never really helped. It weakened right away afterwards. So it's just a waste of investment for them. Their currency goes in a straight line depreciation vis-a-vis the dollar. When the dollar goes up against the Turkish lira or the euro in an exponential way, despite all their interventions. This is a guy, don't forget, Erdogan is a guy who thought 2 years ago that you control inflation by lowering interest rates. He found out it's not the case.
Yeah, okay. Alrighty. Let's move to, yeah, gold as a commodity is quite interesting. Silver, I think it's better not to talk about it because it's been too volatile. Let's move to Brent, perhaps. I saw this morning earlier, by the way, for people watching, Professor Amyuni is also fairly active on LinkedIn and shares his thoughts and sometimes reposts some quite interesting stuff. So I was reading this morning that you were talking about the ceasefire and you don't believe in it. So, linking to this thought of yours, I want to understand, as we know that after the ceasefire was announced 2 weeks, uh, the Brent was down minus 10% roughly. I think someone was quoting minus 15% also, Brent. So, tell us where and how traders would see Brent right now, and is below 100 the new thing, or you think it's going to go back up? What are your thoughts?
If I knew Shahar, I wouldn't be sitting here. If I knew where oil is going, I mean, it's like oil has to be seen in a different way. In 2022, when the Ukrainian war started, that was the first shock. That was the initial shock. Nobody was prepared. Positioning in the commodity was light. Nobody was talking about oil that much. It was a major shock, which everybody was unprepared, and that's why this been a much higher volatility on oil at that time. It went up faster than people remember. Today, with the flow of oil being not as dependent on Russia, countries have prepared themselves for this shock. So we've seen a lot of volatilities, mainly due on the Trump administration comments, constantly contradicting comments, just like last night, obviously. As far as where oil is going, yeah, I don't believe in the ceasefire because the points that the Americans are requiring from the Iranians and the points that the Iranians are requiring from the Americans don't match at all. So we'll see what happens in Islamabad Friday. They have to in the first meeting, but there's going to be some major disagreement on a lot of key points from each side, and this uncertainty is going to create some new volatility. And I think that this uncertainty, the markets are ready to start moving those oil market prices. The second there's some uncertainty, there's going to be some volatility. And we might see oil going back, maybe not to 115 right away, but above 100. But even if there's some agreement, because of the disruption in oil production, in oil shipping, oil will remain in the 80s for sure, 80s, 90s throughout 2026. I mean, don't forget, even if the Strait of Hormuz opens tomorrow, okay, the first tanker to reach Asia is going to take a month. So the war lasted a month. So the tankers that left right before the war are just arriving in Asia right now, okay? And then there hasn't been any departure of tankers from the Strait of Hormuz since. So during this coming month is going to be quite challenging, okay?
Yeah.
So yeah.
Yeah, that one is a very interesting point. Just this morning at 8 a.m., I woke up and I was trying to understand, and I was discussing with Claude about what is the average duration that a Middle East to Asia shipment of oil would take, and I was discussing with different countries. I was actually going to send it in the group chat that we have of the course, and it's very interesting because to India is like 5 to 7 days, which is fine, but then if you go further to Korea, to Japan, to also China, Thailand, it takes like 20-25 days for a tanker to go and come back.
Correct.
And I was reading someone on Bloomberg was talking about there is a 2 week ceasefire. Okay, everyone stuck on the sea can go and deliver the oil, but then they cannot come back because you need 20 days for a round trip, 25 days for a round trip, and the ceasefire is 14 days. So you come back and you're being hit again if nothing positive happens.
Exactly.
And then people will not deploy new tankers, as you're saying. Yeah, new departures are not happening. Only the ones stuck are moving. Interesting. Also, I also think very similar that oil might not go back to, let's say, 60s, 70s at all, because there is this interesting one that the correlation of geopolitical risk index, this is some research by Deutsche and Bloomberg together, that the correlation of geopolitical risk and oil is much larger than geopolitical risk and gold. So so that's how I kind of understand it also, that okay, maybe gold is probably not performing as much in geopolitical risk cases, and oil is, because this correlation for years has been
Yeah,
people moving to oil.
there's a huge political geopolitical premium right now for sure. And talking about where the oil comes from, all those oil producing countries, especially the Emirates, are never going to be the same as before. I mean, their safe haven status, their AI investment, their tax preferential treatments. I mean, there's going to be the real estate business, the real estate boom business over there is going to be a huge premium now. So people are going to wait a while before they invest back there, I believe, and that's going to hurt them a lot. But as far as oil, yes, don't forget the production sites have been halted, and it takes longer to start a production site than to halt it. So not only the Strait of Hormuz, okay, it's open, fine, but the production has to be reinitiated, and that takes 2 to 3 weeks minimum to reinitiate an oil production plant. So the flow is not going to be there right away. And the French news were saying today that usually we see at the pump oil go up and down according to markets. In the US, when I was there last 2-3 weeks ago, you can see the price of oil go up and down according to the market prices. Okay, here it's not going to be the same because there's this problem of supply availability right away, which is not there. So it's and there's the difference between Brent. I don't know if you noticed, but for the first time, that was interesting. WTI was trading at a premium to Brent, whereas the opposite usually. And why is this? Because WTI flows through pipelines. Okay, Brent flows through tankers. So the pipelines, there was a huge demand for WTI because it was available. Okay, and the price went up. Usually, the Brent goes through the pipeline, takes more time to go to the harbors, through the pipes, etc. Whereas the tankers, they just keep on moving. There's a constant flow of tankers. So Brent always traded at a higher price than WTI. And this time, you have WTI trading at a higher price than Brent, and there was a lot of arbitrage trading going on in there as well.
Interesting. Okay.
That never happened in history of oil. The WTI was trading at a higher price than Brent.
But wasn't also WTI's price not because what I remember is Brent was, of course, because of the Strait of Hormuz closure and other things, Brent was skyrocketing, but WTI was not moving as much, right?
Yeah, but then it reversed because
It changed. Oh, okay.
because there was no oil available from Brent, from the tankers.
Okay,
The whole
interesting.
demand went towards WTI. So huge demand for it, the price went up.
Interesting. I did not know this. Also
It was a
interesting.
supply and demand issue. It was a supply and demand issue, yeah.
Okay. Oh, all right. I think we discussed FX and commodities. Let's move to the final asset class for this podcast, and we can slowly wrap things up also. I want to discuss some bonds. Maybe we start with an overview of what different bonds in different countries are doing. Of course, US is important. The world looks at it, but I also understand there are other European bonds or emerging market bonds.
Yeah, I mean the obviously the major the major bonds are the US dollar treasury bonds, European, Japan, and China bond. Funny enough, the Chinese bond during this war are the ones that have outperformed all the other bonds. The yields actually went down to 180% on the long term I'm talking about.
Why is that?
Because they didn't have, first of all, the inflation doesn't affect them this much. They don't depend on oil as much. A lot of the cars is electrified. Okay, they depend on oil more on diesel, but not really on gasoline itself. Okay, they don't depend on gasoline itself. In a barrel, I showed you in class everything you can do from a barrel of oil. Okay, it goes from asphalt to jet fuel to kerosene to petrochemicals and to gasoline for cars. Okay, the electrification of their car industry doesn't make them as dependent on oil. And besides, they anticipated very smartly last year by buying and filling all their tanks in China. I mean, China was the one supporting oil prices in 2024, 2025, when oil prices were going down because of extra supply. They were the only big buyers. And they filled all their tanks, all their need was filled. Okay. Now there's a gap. This month there's a gap. Of course, we talked about this gap of tankers arriving in China. It takes a month, but they they have 2 to 3 months availability of oil within their country from their huge imports in 2024, 2025. So no inflation anticipated. So the bond yields did stay at the same level, even went down a little bit compared to European yields, to Japanese yields, or to US yields. As far as China yields, 181 on the 10-year. As far as Europe is the continent that's being most hurt. I mean, the major import of oil and gas. Rising oil prices is definitely hitting consumers. Big fiscal concern as well. I mean, Europe has no more money to subsidize during a crisis. Lorry drivers, transportation, there's no subsidies, no more money. And sorry, and there's a geopolitical risk with Russia. So Europe was the one most hit, and we saw yields skyrocket in Russia as well. The US, interesting part about US bonds, yields did go up. Now everybody says, yeah, but US is a major exporter of oil. Now, coming back to oil and bonds, is that you have to forget there's light oil and heavy crude oil, okay? The US refineries in the Gulf of Mexico, I mean, Texas, etc., the refineries are mainly done for heavy oil. And heavy oil is imported from Canada. US import heavy oil, and they export light oil, okay? So light oil is not used in transportation, okay? It's heavy crude that's used in transportation, okay? So the inflation fact, even though the US is a major exporter of oil, it's the oil that they don't really need. It's the oil that they're export. The oil they need is the heavy crude that comes from Venezuela now, obviously, and Canada. Okay, so when Trump says we're not concerned about the Strait of Hormuz. He's right. I mean, the Strait of Hormuz, the U.S. imports 2 to 3% of the Middle East oil only. 2 to 3%. Their major is from Canada. Okay, now they have it from Venezuela, but major from Canada, the heavy crude. So the inflation went up because the oil market prices are globalized, obviously, are globalized. So when WTI goes up, Brent goes up, etc. They're correlated, and that's what pushed U.S. inflation up and yields up on those U.S. bonds. So Chinese bond yield down, Japanese up. They were already going up, Japan, but even worse now with all the oil import cost. European worst case situation, and U.S. Yields went up, but they were going up before the war as well. We're at 395. We went to 450 during the war. We're back to 426 this morning. So we're talking a big rise, but the majority of the rise went up before the war, and then it accelerated towards the war, and it came back strongly today on the downside. So 426 for 450 on the USU.
And help me understand, because, for example, when we say during war, you take like refuge, yeah, in safe haven assets, and one of them is let's say U.S. Treasuries. So when you say, or when we saw the U.S. Treasury yield spike during the war, so does it mean that investors were not moving into treasuries, because that just means that treasuries were falling, yeah, the price of treasuries. So investors are moving away from treasuries.
Yes, because the bonds this time acted as an inflationary fear.
Okay.
Here it's an oil shock, which means higher inflation. The gas at the pump in the U.S. went from $3 to $4. It went up 30% within a month. That's in the U.S. consumer less money to spend somewhere else. So on one side you have an inflationary shock, okay, which means the Fed has to increase interest rates to fight inflation. And the central bank, we'll talk about it later on maybe, central bank is also fighting a slowing economy, despite having a very strong labor market last week with the non-farm payroll, extremely high. But coming back to the oil effect, so oil was inflationary. So people thought, okay, inflation's coming back to the U.S., interest rates are going to be increased, bond yields are going to go up, bonds are going to go down. So here we had equity go down, as we said, we had bonds go down, bond yields up, okay, and we had gold go down. So all those assets, the 60-40, 60% equity, 40% model portfolio, didn't hold this time, and it doesn't hold anymore. The investments spectrum is different now. It used to be shock, we move into bonds. It's not the case.
Yeah, because totally makes sense, because nothing was working. Even the equities were down, and then also the bonds were down. Okay, makes sense. Yeah, cash makes sense. Alrighty. I'm reading a lot in the news about bond steepening, terms like steepening, yeah, flattening. Maybe if you could explain, for me would be a revision, because I know it's also part of our fixed income course. So what is bond steepening, and when you hear yield curve steepening, what does it mean?
Okay, the yield curve, first of all, it's a graphical representation between maturity of the bonds on the horizontal axis and interest rates on the vertical axis. So we have a yield curve, which is normally positive, which means short-term duration for short-term rates. And the longer you go out in maturity, the higher the interest rates, which makes sense. People want more return on their investment as they part their money a longer time. A steepening of the yield curve and flattening of the yield curve refers to the difference between the short-term rates and the long-term rates. So usually the market looks at the 2-year rate and the 10-year rate. We look at the difference between the 2-year rate and the 10-year rate, which is about 55 basis points today, 0.55%. So steepening would mean that the curve steepens. That means when the curve steepens, that means the difference between short-term rates and long-term rates widens. Flattening would mean that the difference between short-term rates and long-term rates diminishes, narrows, okay? So right now the situation is the following. We have an inflation fear, because even though oil went down 15% this morning, it's still in the 90s. So there's an inflation fear, and we think that the central bank, the Fed, is going to increase short-term rates, which means the short-term rates are going to go up, and long-term rates are going to go stable or up as well, but not as much. So you're going to have a flattening of the yield curve. The difference, as short-term rates go up, the difference between short-term rate and long-term rate is going to narrow. That's flattening. Steepening would mean when the central bank decreases rates. Don't forget the central bank controls short-term rates only. So we're talking about the short end of the yield curve. So when the central bank decreases short-term rates, the short-term rates goes down and long-term rates go up. So the difference between short-term and long-term rates widens. And to conclude on this shape of the yield curve. Every time the yield curve flattens or is straight, that means short-term rates and long-term rates are very close. It's usually followed by a slowdown in the economy and a correction in the equity market. Why? Because short-term rates go up quite a bit. Consumer loans are short-term rates, so consumers spend less, companies make less revenues, profits go down, layoffs, etc., recession, etc. So that's the flattening and the steepening of the yield curve. So right now, now with oil going down but still remaining up, we'll have to see, is the Fed going to increase interest rates to fight inflation, or is the Fed going to decrease interest rates to fight what was until last week a weak labor market, which we have seen it's not that much of a weak labor market. So the Fed has to focus either on the labor market or the inflation front. Right now, the labor market seems to be healthy with this 176,000 job creation last month. So they're very likely going to fight inflation from these higher oil prices, which means the next move might very well be an interest rate hike rather than an interest rate decrease, which will flatten the yield curve.
Okay, yeah, that's very clear. And I just read a stat this morning about for the last 60
You
months.
read a lot in the morning. I like that.
Yeah, actually, well, especially this morning because I had a podcast with you, so I had to be sure that I'm having the right numbers. I'm seeing all the stats where the markets are.
A lot to read this morning.
But also in general, I don't know if it's good or bad, honestly, because there are conflicting opinions that you're just cramping your brain in the morning with a lot of what's going on in the world rather than sitting in the sun or going for a walk or run. So I don't know. It's conflicting opinions, but I like to do it. I like to see what went down overnight. But this was interesting because someone said that for the last 60 months, US has been under the inflation target of 2%. Yeah. So consecutive 60 months, by the way, not the last 60 months, but consecutive 60 months. So yeah, I mean, rate cuts, I don't see them in the room also, but you never know with all that's going on, going with White House. Last question, because I see we're at the 45-minute mark. So I would like to conclude also. The last asset class, I would call it rather, because I wouldn't call it bonds. Private credit. There is a lot of conversation happening about private credit. Uh, for me, I understand what private credit is, but I don't understand if there is some relation with bond markets, what is going there, how do you look at it, and if you can give us a summary, because these redemption requests from private credit funds have been halted, and there are concerns that we are in, in those situations where when Lehman crisis was happening, a lot was going on in the financial system, but we did not know what's going in the behind the scenes. So what's your take?
Okay, let's define first. The bond market is public. The private credit is private, obviously. So the private credit is often banks and non-financial institutions as well. We'll talk about this, that supply loans to companies that are not able to get normal bank loans. Okay, and those loans are made at extremely high interest rates. We're talking above 10%. To companies that are weak, are growing, would grow in a normal economy. Any slowdown in the economy would hurt those private companies. The private credit, we all heard about Jamie Dimon's cockroach image, and he said when there's one cockroach in the kitchen, there's more others, and he's right. So the private credit, the problem with the private credit is that the institutions that are giving those funds to those companies on a private way are not regulated like banks are. Banks, for example, to make a loan of $100 have to put aside, for example, $8 as a collateral. Okay, those non-bank institutions, okay, the Apollos, the KKR, the Blackstones, the Ares, all those companies are not regulated by the FDIC. They're not regulated by anyone. So it's cowboy land basically. Okay, but the problem is there have become, just like the banks, too big to fail. If one of them fails, the whole system might fail. So those are companies that are taking risks, that are not regulated, and that are starting to be very, very likely. I mean, they're starting to be, and they are too big to fail. Now, they let Lehman fail. We saw with this what would happen. If one of those institutions fail, and they have a lot of funding from normal banks, the Bank of America, the Wells Fargo, the Citis, the Morgan Stanley, the Goldman Sachs. So everybody's got this money in there. Okay, so there's a lot of money circulating in this private credit, either as investment or as loans, that remains opaque. And if one, we had Brent Colors and we had those two companies in the fall that have defaulted. That's how it started. If some bigger institutions fail, that might lead to a major crisis, and there'll be a bailout because they're too big to fail, basically. So that's the problem with private credits. Unregulated business, too much risk, too much leverage, and being too big to fail, not too safe. That's what I believe.
That's clear.
This might be, and funny enough, it's unbelievable. I read yesterday, Morgan Stanley is starting a fund. Morgan Stanley is starting a fund of private credits. So does that mean they're holding a lot of private credits on their books and they want to sell them through a fund to investors? That remains to be seen, but that might not be impossible. We saw what Goldman Sachs did with the Abacus fund in the financial crisis, and you know that when they were selling those subprime to the investors, they knew that they would default. Would that be the same with Morgan Stanley? I hope not.
Perfect. Awesome. I think the whole conversation today was super insightful, and once again, I would like to thank you for taking the time.
Thank you for
and spending this time talking about different asset classes.
Thank you for having me. I really enjoyed it, and I think you have a big exam coming next Monday, right?
Yeah, I need to
ready
start.
and make sure